So the ISA 240, the auditor's responsibility relating to fraud in a financial statement, defines fraud as an intentional act by one or more individuals among the management, those charged with governance, employees, or third parties involving the use of deception to an unjust or illegal advantage. Fraud may be perpetuated by an individual or in collision with the people, internal or external to the business. So that's what fraud is considered as. The two types of misstatements that could be caused by frauds are relevant, which are relevant to the auditor, are below. So when it comes to frauds, fraud is an intentional act. Like, it's not done without pure sense and knowledge. Like, they are doing it intentionally among those charged with governance, or maybe employees, or even by third parties, to take illegal advantage and either to steal the money or to misrepresent the assets, etc., in a negative in a positive way, to showing it in a positive way. So the misstatements could be resulting from, one, fraudulent financial reporting, where they are manipulating the financial statement in such a way that the data could be misrepresented or misstated purposely to show if there is a liability, they don't show the liability, or if there is an asset, they show the assets as heavier. Or another aspect is where the misstatements resulting from misappropriation of assets, like stealing cash from the inventory, stealing cash from the bank account, or whatever in your till is stealing inventory for the personal use, etc., is called as misappropriation of assets. So let's understand the responsibility of the management and the auditor in relation if a fraud is being detected, or if there is a fraud, what is the responsibility of the auditor and the management. Now, when it comes to management has the primary responsibility of the prevention and detection of fraud. Like, they need to ensure that the fraud is prevented. They should put strong controls. They should have proper cultural impact, strong environment and strong culture, and they need to hire people who are not going to commit such activities, etc. So strong systems, controls, internal controls, culture, everything has to be established by the management themselves to ensure that they prevent fraud. At the same time, if the fraud has been detected, then it is their management's responsibility to detect the fraud and take action on it. Like, to give you an example, if they are establishing strong controls, automatically there will be certain kind of detection procedures that will enable the system to identify that there has been a fraud that has been detected. So such thing also is required to be detected and identified if your fraud has to be undertaken. However, for the auditor, it is his responsibility just to obtain reasonable assurance. He just need to obtain reasonable assurance that the financial statement are free from the material misstatement which are caused by fraud or error. Like, to give an example, it is his responsibility to identify and assess the risk of material misstatement due to fraud. Like, first step itself is, during the stage of planning, he needs to identify or note down if there could be a chances of a fraud risk. So in audits, what we do is we create something called as a specific fraud risk apart from significant risk. Automatically fraud risk will be significant risk, but even if there will be other risks which are not considered as a fraud risk but could be considered as a significant risk. Fraud risk is where there are like lack of controls, or there is a lot of manual interventions to areas which are risky. Like, for example, if there is a revenue and there is cash revenue being dealt with, it could be considered as fraud risk because someone could steal the money. If there is inventory handling which is too much of manual, people are there and there is lack of system or CCTV cameras, then there is fraud risk. So it is very important that auditor actually identifies the fraud risk in relation to a company that they audit. Obtain sufficient evidence in relation to the risk of material misstatement through designing and implementing the appropriate responses. So once we identify the fraud risk, second is to obtain sufficient appropriate evidences. The third is to respond appropriately to the fraud and suspect fraud identified during the period of the audit. So identify the fraud during the period of the audit, suspect the fraud, you need to identify the fraud that you are identifying during the period of the audit. So what should be the audit approach the auditor should take when there is susceptibility relating to the fraud? Now the members of the engagement team should discuss the susceptibility of the entity's financial statement to material misstatement due to fraud. So whom should they discuss to? They need to make inquiries. Now when it comes to inquiries, to whom should we inquire? Like we need to inquire with the management. We need to inquire with the management. Okay. And then we need to inquire with those charged with governance. So when we inquire with the management, inquiries are made regarding whether there is what are the risk of fraud in the system. How does the control prevent and detect the fraud? What are the controls in place? What kind of system you have created which ensures that the frauds can be detected as well as prevented? Are you suspecting anyone who have conducted a fraud, or have there been previous scenarios where there have been fraud conducted? And how did you manage to identify such fraud situations, etc.? So those kind of inquiries we need to make with management as well as with those charged with governance. With those charged with governance, we need to kind of be more prudent and ask them questions like how are they implementing the controls to mitigate the fraud? Like what kind of position they are in to override the fraud situations? How are they able to identify the fraud situations that have happened in the business, etc. They could also do inquiries with others, not just management or those charged with governance, but they can also inquire with others like internal audit, finance personnel, employees. Technically, what happens when there is a fraud that's happening, maybe it is not yet detected by the management or those charged with governance, so they don't know. But the real employees who are working on a daily basis, their team members would have conducted a fraud, or they would be conducting a fraud, and the employees are little scared to disclose that matter. So because of that, you need to inquire with certain individuals who are present in the organization to identify if there is a chances or cases of fraud. You can also scrutinize the documents, like scrutinize the controls, the systems, to see if there are any lapses where there could be a chances of a fraud. They could deal with complex or unusual transactions. What are the internal or external legal services that could be obtained? Those things could also be identified. One thing the auditor should always focus on his approach is something that is called as professional skepticism. What is professional skepticism? Having a questioning mind, doing a lot of inquiries, keep asking questions like what exactly is happening. Having those skepticism, having a skeptic mind is what the auditor should look for. He needs to keep digging for the important factors, whatever the knowledge he comes to know. Being alert to the situations or conditions around him is something that he needs to focus on when it comes to professional skepticism. It's very important that he focuses on those aspects. ISA 315 are more detailedly discussed in the upcoming chapters that we're going to do. But one thing in the primary factors that could help us identify or recognize fraud is something, a procedure that auditor does is called as analytical procedure. Analytical. Like, to give an example, let's say, revenues are going and going and going. Suddenly it spiked 2 times. Suddenly it spiked 3 times. That is a pure indication of a fraud. Like, what happened that the growth came 2-fold or 3-fold of growth that you are expecting. So analytical procedures do help us indicate certain kind of risk in relation to material misstatement, like fictitious sale, as I told you. There could be a case where, expenses, you're maintaining an expense and suddenly the expense starts falling down. That could be an indicator. Like, to ensure that the profit is higher, either the company could increase the revenue or they have to reduce the expenses. So suddenly when, you're seeing a normal expenses and suddenly it starts growing down, you start to see a huge fall. That shows that, oh, you know what? Is there a fraud there? Like, are they not showing certain expenses they are supposed to show? Could be an indicator of a fraud. So analytical procedures do help us to identify preliminary sources of any fraud cases.